If your card was declined when you tried to buy silver, it was not a glitch, and it was not fraud protection. What you experienced was something far more serious. It was a quiet signal that the rules are changing. Not announced, not debated, just enforced. This is how capital controls begin in the real world, not with headlines, but with confusion, silence, and denials. Picture this. You're at home, maybe early in the morning, maybe late at night. You're on a major bullion dealer you've used before. The math checks out. Spot price looks fair. You're not gambling, you're simply converting dollars into something tangible. You hit checkout, enter your card details, and then it happens. Declined. The message says insufficient funds, even though you know. That's not true. You refresh your banking app. The money is there. You try again. Declined. So you call your bank. After the wait, the explanation shifts. Now it's a high-risk transaction. Now it's enhanced review. No one can tell you who decided that buying silver is risky. No one can explain what rule you violated. And when you ask too many questions, the conversation ends. That's the moment most people dismiss and move on. They shouldn't. Banks don't act randomly. They act when incentives change or when pressure is applied. And right now the incentive is clear. Money is trying to leave the system. Every physical ounce purchased is a quiet rejection of debt-based currency. Those decisions don't show up on CNBC, but they show up in internal risk models. And the response is simple: add friction. This isn't about protecting you. It's about slowing exits. When systems feel stressed, they don't warn the public. They tighten controls quietly and let people blame themselves. History shows this pattern over and over. Restrictions always start small, confusing, and deniable. Silver is not the story. It's the signal. What matters is why this is happening now and what it tells us about what's coming next. Once you understand that the decline on your screen stops looking like an error and starts looking like a warning. If this resonates, press 1 in the comments to continue to chapter 2 or 2 to stop here. And if you value analysis that cuts through noise instead of repeating it, subscribe to the channel and share your perspective below. To understand what's happening, ignore the explanation and study the pattern. Banks claim this is about fraud or customer protection, but fraud does not appear everywhere at once, targeting the same type of purchase across different institutions. That kind of consistency only happens when rules change at the system level. The first signs didn't come from headlines, they came from people comparing experiences, declined transactions, identical warning messages, different banks, same language. At first it was easy to dismiss, but then the volume increased. What looked like isolated incidents became a repeating structure, different platforms, same outcome, declined without explanation. This is how modern restrictions are implemented, quietly and through automation. No announcements, no public debate. Risk categories are adjusted, algorithms updated, and enforcement happens instantly. Most people never realize what changed. They just feel resistance where there used to be none and assume it's their own problem. Notice what isn't being blocked? Jewelry purchases go through. Luxury spending clears. Entertainment transactions process without issue. The line isn't spending money. The line is converting money. When dollars are exchanged for something that exists outside the financial system, scrutiny appears. Once a purchase is flagged, there is usually no human review. The system evaluates behavior, not intent. Past purchases matter, frequency matters, patterns matter. To the algorithm, this isn't saving, it's potential capital flight. Systems don't evolve this way unless pressure is building behind the scenes. Liquidity stress shows up in controls long before it appears in headlines. Institutions restrict exits quietly and let people blame themselves. This isn't about silver yet. It's about recognizing the early shape of restriction while it's still subtle. Now we need to talk about timing, because timing is never accidental. This shift didn't happen in a vacuum, and it didn't happen slowly over years. It appeared suddenly, then spread fast. That alone tells you something important. Systems only change this quickly when stress reaches a threshold. Behind every declined transaction is a risk model, and behind every risk model is a fear the institution won't say out loud. Banks are not worried about you losing money on silver. They're worried about liquidity. They're worried about collateral. They're worried about what happens when too many people decide holding dollars no longer makes sense. When confidence weakens, behavior changes. People don't announce it, they just act. They move quietly, one transaction at a time, converting digital balances into things that don't depend on promises. That behavior is invisible until it reaches scale, and by the time it does, institutions are already late. This is why the response isn't a public warning, it's friction, small obstacles that discourage action without provoking outrage. A decline card, a vague explanation, a long hold time. Enough inconvenience to slow the flow, but not enough to cause panic. This is behavioral control, not regulation. History shows that financial systems rarely collapse from one event. They fracture from loss of trust. When trust erodes, exits become dangerous to those in control. That's when restrictions begin, even if they're not called restrictions yet. What matters here is not whether silver prices move tomorrow or next month. What matters is that the system is behaving defensively. Defensive systems don't do that when they're healthy. They do it when they're trying to buy time. Once you understand that these declines stop feeling personal, they start feeling strategic. And that realization should change how you interpret everything that follows. To see where this leads, you have to understand how quietly control is applied in modern markets. There is no announcement, no emergency broadcast, no new law passed overnight. Control today is embedded in systems people already trust. Banking apps, payment rails, compliance language that sounds boring enough to ignore. That's why it works. Every transaction flows through layers of classification, merchant codes, risk tiers, behavioral flags. When one of those categories is redefined, reality changes instantly for millions of people, even though nothing appears different on the surface. You still have your account, your balance still shows the same number, but your ability to act is narrowed. This is why the explanation always feels hollow. Policy, compliance, automated review, these are not answers, they're shields. They prevent accountability while signaling obedience to something higher up the chain, and that chain doesn't lead to customer service, it leads to systemic risk management. What's happening now fits a familiar pattern. When institutions sense strain, they don't raise interest rates first. They don't issue warnings first. They protect liquidity first. They reduce optional outflows. They slow behavior they can't openly forbid. The goal is not to stop everyone. The goal is to stop enough people to maintain control. The most dangerous part is psychological. When friction is inconsistent, people doubt themselves. They assume error. They assume bad timing, they don't compare notes. That delays collective awareness, and delay is exactly what stressed systems need. Once you recognize this, you stop asking why your transaction failed, and start asking what pressure made failure necessary. That question matters more than any price chart. At this point, the question is no longer whether this is intentional. The real question is what pressure forced it to happen now. Financial systems don't tighten access unless something underneath them is weakening. And that weakness always shows up first in places the public isn't meant to watch. Liquidity is the silent constraint. Banks operate on confidence and collateral, not cash in a vault. When the value of that collateral becomes unstable, everything downstream becomes fragile. Bonds lose value. Balance sheets compress. Suddenly, the system cannot afford optional outflows, especially into assets it cannot rehypothecate or control. This is where timing matters. Rising yields aren't just numbers on a screen. Higher yields mean lower bond prices, and lower bond prices mean weaker collateral. When enough of that collateral weakens at the same time, institutions enter defense mode. They don't announce it. They adapt internally. What looks like a simple declined purchase is actually the edge of a much larger response. A response designed to slow behavior that accelerates stress. Physical assets remove liquidity from the system permanently. Once converted, those dollars don't circulate. They don't support leverage. They don't stabilize balance sheets. From the system's perspective, they disappear. That's why this pressure isn't applied evenly. It targets behavior, not individuals. It discourages exits without confronting them. It buys time. And when systems buy time, it's usually because they need it. This doesn't mean collapse is immediate. It means strain is present. And when strain is present, control becomes more valuable than transparency. That's the environment you're operating in now. History gives context to moments like this because none of this is new. What changes is the method, not the motive. When currencies come under pressure, authorities don't start by taking assets. They start by controlling access. It's quieter, easier to justify, and far less likely to trigger resistance. In earlier eras, control required laws and enforcement. Today, it requires algorithms. A category reclassification can accomplish what legislation once did without debate or visibility. Ownership doesn't need to be outlawed if acquisition can be slowed to a crawl. Most people give up long before confrontation is necessary. This is why comparisons to past monetary stress matter. Not because history repeats exactly, but because behavior does. When confidence weakens those in control, act to preserve the system they depend on. They frame it as stability, they frame it as safety. But the effect is the same: fewer options for everyone else. What makes this phase dangerous is its subtlety. There's no clear moment to react. No announcement telling you conditions have changed. You only notice when you try to act and discover your choices are narrower than they were before. That's why early awareness matters. Not panic, not emotion, awareness. Systems rely on delay. The longer people doubt their own experience, the longer control remains effective. This chapter isn't about predicting dates or prices. It's about understanding the environment. And environments like this reward preparation, not reaction. Now, we need to widen the lens because this behavior doesn't exist in isolation. While access is tightening for retail buyers in the West, something very different is happening elsewhere. Capital is not disappearing. It is relocating with purpose, scale, and urgency flowing toward assets that exist outside fragile financial promises. Across the global landscape, large players are positioning quietly. Governments and major institutions don't chase headlines or react emotionally. They respond to balance sheets and long-term risk. When instability rises, they move out of abstractions and into physical materials they can hold, store, and control. Not paper exposure, not leverage, reality. What matters here is scale and synchronization. Systems can tolerate individual exits. They cannot tolerate imitation at scale. Retail behavior becomes dangerous only when it begins to mirror institutional behavior. When individuals act like funds and sovereigns, pressure compounds rapidly. That is when restrictions accelerate. This creates a widening divide that most people don't notice until it's permanent. One group accumulates early, quietly, and with access. Another group is slowed, discouraged, and eventually priced out through friction delays and rising barriers. Over time, this separation becomes structural, not temporary. This is not about fairness or morality. Under stress, systems don't optimize for fairness. They optimize for survival and control. Seen through that lens, these restrictions are not random. They are defensive responses to a monetary transition already in motion. At this stage, the most dangerous mistake you can make is assuming there will be a clear, unmistakable moment to act later. Financial transitions never arrive with countdowns, warnings, or official announcements. They unfold quietly in layers, each one reducing flexibility while maintaining the illusion that nothing fundamental has changed. By the time the shift becomes obvious to everyone, meaningful options are already gone. What you are witnessing now is not collapse. It is compression. Access narrows gradually. Convenience erodes slowly. Actions that once required a single click begin to require explanations, approvals, alternative methods, or workarounds. None of this feels dramatic in isolation, and that is intentional. Systems under stress do not impose control abruptly unless they are forced to. They shape behavior patiently, allowing people to adapt, rationalize, and accept limits without realizing what they've lost. Most people wait for confirmation. They want headlines, official statements, or extreme price moves to validate concern. They want permission to act, but confirmation always arrives after access tightens, never before. By the time certainty appears, flexibility has already been exchanged for reassurance. And reassurance is always expensive during periods of transition. This is why preparation matters more than prediction. You do not need perfect timing. You do not need absolute clarity. You need awareness while choices still exist. Systems rarely reverse restrictions once they are introduced. They normalize them. They expand them quietly. Over time, what once felt restrictive simply becomes the new baseline. What feels inconvenient today will feel normal tomorrow. What feels questionable today will feel justified later. This is how control becomes invisible, And once control is invisible, it is rarely questioned, let alone challenged. The narrowing doesn't happen all at once. It happens just fast enough that most people adjust instead of resisting. Understanding this changes how you interpret everything you're seeing. The goal is not to frighten you. The goal is to recognize the phase we are in while awareness still provides leverage. Once you recognize the narrowing, the most dangerous belief you can hold is that the choices still being offered to you are neutral. In systems under stress, choices are never neutral. They are guided, incentivized, and constrained in ways that shape behavior without openly forcing it. What feels like convenience is often a corridor designed to keep movement predictable and controllable. This is where most people lose time. They assume the system will remain functional long enough for them to react later. They believe access will remain open simply because it always has been. But stress systems do not fail evenly. They fail at the edges first. Access degrades in specific areas while appearing stable elsewhere. Some doors remain open, while others quietly lock, and by the time the pattern becomes obvious, positioning is no longer proactive, it is reactive. This phase rewards early movers not because they are smarter or more informed, but because they acted before friction became normalized. Once barriers feel ordinary, people stop questioning them. They stop pushing. They adjust expectations downward and mistake adaptation for stability. The psychological shift is the real danger. When people accept reduced options as normal, control no longer requires enforcement. Compliance becomes voluntary, and voluntary compliance is far more efficient than force. Systems depend on this shift. Once it happens, reversal becomes unlikely. At this point, the question is no longer which asset performs best or which strategy generates the highest return. The real question is whether you still have agency. Agency erodes when action becomes conditional. When every move requires permission, explanation, or delay, control has already changed hands. Understanding this is not about fear or panic. It is about clarity. Clarity allows you to act deliberately instead of emotionally. And in periods like this, deliberate action is the difference between preservation and loss. This is where everything comes together, because the purpose of understanding these patterns is not fear and it is not prediction. It is strategy. Periods like this don't reward emotion or reaction. They reward clarity, patience, and preparation. When systems tighten, the goal is not to outsmart them in the moment. The goal is to position yourself before pressure becomes visible. The lesson is simple but uncomfortable. Waiting for permission is a losing strategy. Waiting for certainty is even worse. Financial history shows that the largest shifts always happen while most people are still debating whether anything has changed. By the time consensus forms, access has narrowed, prices have adjusted, and optionality is gone. This doesn't mean abandoning the system overnight or acting recklessly. It means thinking in terms of resilience instead of returns. Diversification is not just about assets, it's about access, flexibility, and independence of decision-making. The more pathways you maintain, the harder it is for any single restriction to trap you. Strategic thinking in moments like this means acting early, calmly, and deliberately. It means understanding that convenience is often traded for control and that small frictions are rarely temporary. It means recognizing that preservation of purchasing power is not speculation, it is defense. Most importantly, it means refusing to outsource awareness. The institutions managing the system will not warn you when conditions change. Media will not prioritize your preparation. That responsibility rests with you. If you've made it this far, you already understand more than most. Use that advantage wisely. Share this perspective with people who are still confused by what they're seeing. Ask better questions. Compare notes. Stay adaptable. If this analysis helped you see the market more clearly, take a moment to support the channel. Subscribe for deeper breakdowns like this. Share this video with someone who needs to hear it, and leave a comment below with your thoughts or questions. Engagement matters because independent analysis only survives when informed audiences support it. The window doesn't close all at once, but it does close. Stay aware, stay strategic, and don't wait for permission to protect your future.